Hey everybody, it's Brady with your mortgage rates report, and I wanted to give you a little housekeeping update. I made a few changes here. You'll notice that I now list the rates for the 3, 5, 7, and 10-year ARM as well as the 30-year fixed mortgage. And below the rates, you'll actually see a thing I call the trend meter, which tells you what I believe is going to happen to mortgage rates in the next 7, 30, and 90 days. And you'll see it right up here, right above the video. I stopped the commentary along with offering advice whether to lock your rate or not. The reason I did that is because you told me that the commentary was too technical and that you really rely upon my advice about whether you should float or lock your mortgage rate. So rather than bore you with the commentary, I felt that the trend meter would be better. I will offer this commentary via video, just like this, about every week or two, and try to keep you up to date on what's happening. So that leads us to the question: what is happening? Well, back on June 28th, I suggested that you might want to that locking all your loans would be unnecessary. The reason is we were seeing that the mortgage-backed securities market was getting killed. Inflation fears, combined with a fear of insolvency at both Fannie Mae and Freddie Mac, was leading to a sell-off in all bonds, regardless of whether they were mortgage-backs or treasuries. Now, last week, treasury bonds improved, but mortgage-backed securities didn't. It confused a lot of mortgage borrowers. Why would government yields drop, yet the mortgage rates not? Well, what it was the fear of insolvency at Freddie Mac and Fannie Mae that led all of the investors to think that mortgage bonds were just a bad bet. Consider the analogy of a dog on a leash, okay? The treasury market is the owner, and mortgage-backed securities are the dog that kind of scurry away. That's what happened in the mortgage-backed security market at the end of June. While the owner was moving in one direction, the leash was let out, so the dog was scurrying in the other direction. I felt what happened was completely overblown. So this past Monday, I suggested that both mortgage rates should be lower, both this week and the whole month of July. And as soon as this insolvency fear abated, just like the dog who feels the tug on his leash, mortgage-backed securities would come running back to the owner. Well, in this case, treasury bonds. Well, this week we saw treasury yields rise, and mortgage rates drop. So the analogy I can give you is the owner was actually running towards the dog as the leash was tightened. Does that make sense? What's it all mean? Well, while I expect the long-term trend of mortgage rates to rise, like I said in my last video commentary, because of the inflationary fears, we could actually see mortgage rates drop a little bit lower in the next week to 2 weeks. So, if you're thinking of refinancing your home loan, July may be the best option you have in the next 2 years. Because towards the end of July, you're going to see the market start worrying about whether the Fed is going to raise rates in their August meeting, and then the chance will be gone. So that's it. The mortgage rates outlook is sunny for the next 7 to 14 days, but there are some clouds on the horizon, so you better act quickly. If I can help you with your home loan funding, give me a call at 858-777-9751. That's 858-777-9751, and I'm Brady. Thanks.